When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about 2025, the year in review. Also, we'll answer listener questions, and finally, what to look for in 2026. My name is Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. How are you doing? You don't sound like you got that little Christmas cold going on like that.
Yeah. I think they call it the, H2N3 virus or something like that. It's a variant of the flu. I didn't get the flu shot this year, so yeah, I absolutely got it. Was in California and just barely made it back, but we're on the road to recovery here at this point, and I think this is a good reminder for folks listening right now that you can get those flu shots and RSV and all those other things at your local pharmacy at no charge. But yeah, this has not been fun. I think maybe this might be the worst respiratory thing that I've ever had. But we're going to tough through, Jeff. You know, they say the show must go on.
That's right.
So we're looking back at the most important events of 2025 that shaped the financial lives of retirees and soon-to-be retirees and investors. And 2025, Jeff, it was a real roller coaster in the markets. How did the stock and bond markets perform, and what does that mean for someone already retired or nearing retirement?
Well, I mean, the stock market's, as I mentioned, is overvalued and historically overvalued. There's more business owners are selling their stock than buying the stock. More hedge funds are liquidating. And surprisingly, even in spite of that, there's been more buyers than sellers, apparently, because the stock market has gone up. The indexes have gone up about 16 or 17% year to date. It's been kind of a roller coaster ride year, but the bias is still trending upwards. Yet the smart money is trending out of the market. And that's a little bit worrisome, as I've mentioned over and over again. And nevertheless, our managed portfolios are beating the market by a long shot, but we're just following the money. We haven't been in Apple, which is only up 5% this year. Microsoft's only up 11. It's had a really good downturn during the middle of the year. Amazon's only up a couple of points. Google's a winner in the big seven. If we look at the Mag 7, which are typically the drivers of the entire market, Google's up about 60% and NVIDIA up 36%, which is really not a very good year for NVIDIA if you consider what it's done over the past. Tesla's been a roller coaster, up about 4.5%. And Meta, which is the other seventh one, is up just roughly 10%. So we haven't seen the robust growth in those big cap, huge market cap stocks, the trillion-dollar companies, as we would expect. Google seems to be plugging away. It didn't get way out of whack overvalued like some of the other ones did, and the market's kind of catching up to it. But going forward, who knows? As long as the market makers can sucker people in to continue to put money into the market or continue to fund their 401ks and they keep on buying, the prices will go up. I think there's a kind of an interesting phenomenon that we're seeing, though, and that is that 90% of executives or directors, higher ups in companies of all these companies, including the Mag 7 that I just mentioned, and others across the board, are more than 90% sales, not buys. So they're not buying their own stock, they're selling their own stock. Warren Buffett's more than a third in cash. He's a pretty smart guy. Ray Dalio is another guy that's scaling way back and going into cash. He's the biggest hedge fund manager, I think, still. Buffett and Dalio probably don't do a lot of the hands-on trading as much anymore, but they've still got the reputation. It's their company that's doing it. But the big hedge funds, the big portfolio managers are dialing back their holdings. And I think they love these little market corrections because they sucker people into selling when they just open the market low. They'll just open the market and just throw a bid out there, meaning, hey, we're only going to buy this stock at this price. And you wake up and the markets or your stocks are down 5%. You get scared and you sell them and they go, haha, we just got them cheap. We're going to they're playing a trading game with us. So that's a little worrisome because the growth in the market is not slow and steady and kind of like the tortoise just plugging away, and earnings are growing. Companies' profits are growing. I think right now it's mostly based on hype, based on the AI industry. It's based on future earnings. They're not calculating depreciation like they should. And they're doing some other things to what I would call cook the books. And they've done that over time, but typically that stuff will catch up. And I'm certain that we're going to have a correction because we always do. The market always goes back. It never can sustain the pricing and the values where it is. We're already looking at a lot more buying going into foreign stocks, some of the emerging companies or even the more blue chip companies in the foreign countries, because people are a bit nervous about having all their eggs in this basket. I mean, if you look at the price earnings ratios of the U.S. stocks, meaning in the 30 range on average on current and maybe 25 on future, that's if they even make money. And that's how much you have to pay for $1 of earnings on a stock. I mean, $30 for $1 of earnings, that takes a long time to get your money back if you're looking at actual values of what you would pay for a normal investment, like a house or most things. But you're looking at price earning ratios in other countries at less than 10%. And that's kind of typical. And that certainly looks like a more fair value. So I think we're seeing some emerging markets and foreign money moving to a little bit more of the foreign stock plays. But nevertheless, America still seems to plug away in spite of its problems, in spite of everything you can nitpick about it. You can call out all the manipulation, but the fact is Wall Street's getting good at it. And the government keeps printing money. They keep playing money games too. And, that money has to go to someplace. And even if the politicians and insiders get rich and play games to make themselves rich, like I think the corruption's runs deep, but that money has to go someplace. And I think even that props up the market a little bit. So if you have money, the market will help you. If you don't have money, you're missing out and unfortunately going to probably be in bad shape down the road when everything costs more, when people who have investments are able to make a good living and retire comfortably, and those that don't. So again, it's kind of a catch-22. You want to grow your wealth so you can get to be retired. You don't want to risk it and lose it in the next market correction. So it's kind of a scary time. And that's why hopefully we can make some money with the money you can afford to risk at this point while the market's still holding in there. About every quarter or so, you get some new report that says, next quarter or the quarter after, 2 more quarters away, we'll probably have the market correction. I was just reading some over this last week that said that they expect that we'll probably be able to have some whipsaw action, which will probably shake a lot of the low-hanging fruit out of the tree so the market makers can swoop it up at a low price and gather and rebuy some of those stocks that have been beat up or that they help get beat up and pad their own portfolios with good price stocks. So we'll probably see some volatility along the road the next couple of years. But some people are calling for the major market crash in 28 or 29. And when you think about that, if there is a major market crash in 20 or 29, that's still a few years away. And the longer the market gets overvalued and stays in this kind of unprecedented area. I mean, not totally unprecedented. I mean, we did have it up here, these values in 29. Of course, we know what happened after that. We had these valuations in the dot-com bomb in the 2000, and we didn't have it quite as bad, but pretty close to as bad during the banking crisis in 08. So we're seeing the patterns repeat. We're just seeing people be able to kind of keep the plate spinning a little bit longer. The powers that be are able to perform some magic, pull some rabbits out of their hat for a while. And I don't know how long that will last, but we do know that things do end up going back to equilibrium. I don't know when they will be. So I think you need to be vigilant. I also think and I'm going to repeat this again and again, hopefully you oversave so you have more than enough to live on in retirement so that you can have a few flat years or correction years where you live on principal protected assets and don't take those big losses by riding the entire portfolio down to the bottom of the next market correction. And again, the longer we wait for it to correct, probably the harder the snap's going to be and the more devastating it will be, because it seems like before every correction, there becomes this unreal euphoria about how, well, this is different this time and it's never going to crash. And, you've been saying that, Jeff, for the last couple of years. And well, everybody's been saying that. The smart money's been saying that for a long time. When we're looking at what they're doing, they're selling their stock. We're looking at the markets being propped up with margin debt. That's where you borrow against your own stock portfolios. And a few months ago, I reported that there was $1.1 trillion, most ever, in margin debt. The numbers that I'm reading is somewhere around 1.8 trillion. So that's people that are borrowing against their own stock, getting crazy because, if the stock market corrects, you end up losing double or triple what you've borrowed. I looked at my margin account. I have an account where I can borrow if I want to, and occasionally I do on a trade or something where I want to buy before I put the money from my bank in my account or whatever, and I'll margin it. They don't charge cheap interest, but at least you can get in if the market starts moving or before an announcement you think is going to be good, things like that. So I know what my margin account will do, and they'll triple my money on my margin account. So if I were to have, let's say, $100,000 in an account, I could borrow 300, or I could borrow up to 300,000 and buy those stocks. Well, what if the market goes down a third? I lose all my money, not a third of my money. So it's a double-edged sword. It's scary. We've got not just margin debt way high. We've got the top searches on the internet are how to get out of my mortgage and save my house and how to get out of a car payment without losing my car. We've got debt on credit cards to unprecedented levels, defaults at unprecedented levels, defaults on mortgages and cars at unprecedented levels. But they're not really talking about that. We've also got banks that don't have to declare bad loans as losses. They can just call them unrealized losses, and they don't actually show up contra earnings or against their earnings when they have their financial report. So you don't even know how strong or not strong the banking industry really is, even though it seems to be holding pretty stable. Those blue chip bank companies, you always put money there and they seem fairly stable, and the trend is still up with most of them. So there's some worrisome things. We've had a decent year. We haven't had the winners. Like I said, the Mag 7 wasn't quite as robust on the earnings front as it could have been. I think we've turned our attention to a lot of these up-and-comer AI stocks and energy stocks that have pulled the indexes up where those Mag 7 have lacked. And so there's still some upward mobility and the trend still looks up. But when is that going to end? When is the gas going to come out? When are we going to find out that not everybody can make billions of dollars in the internet, even though they all think they can? The market's going to end up focusing on a few of the top companies that lead, and the others are going to fall away. So that might be when we finally see that crash, when AI seems to be just ready to get its final push, kind of like the dot-coms did right before the dot bomb. And after that, that's what shook out all the nobody companies, and the winners emerged, the Microsoft, Apple, and Amazon. So I think we have to be careful looking at the market. I've read so many different theories about what the market's going to do next year. I think that was probably your next question. Right. I think with the Fed trying to lower interest rates, we might finally see bonds actually go up in value instead of down. The bond market's been really soft and actually counterintuitive. They're supposed to be lowering interest rate, yet bond prices are going down, which makes interest rates actually go up on anything more than 5 or 10 years. The 20-year bond is down, I think, 5% in the last few months. Well, that's more than the interest you make in a whole year. So that's counterproductive to go into the long bond market, even though you think, unless you're going to hold them for 20 years and be happy with 4%. It is an indication of what's really happening in the market, in the economy, and it's a little worrisome. Our government cannot afford to refinance debt at 5 or 6 or 7% when they've been refinancing at 1% and pretending like it's no big deal. Well, it's going to start being a big deal as $6 or $8 trillion of debt have to be refinanced every year. That's going to drive us into a hole that I don't know how we're going to get out of unless they raise taxes to the moon or just start confiscating property or restructure Medicare, healthcare subsidies, basically end all aid programs and maybe cut Social Security. I don't know how they're going to get out of it without doing some drastic stuff. And I don't know that DOGE cut enough fat out of the excess and frivolous spending that the government does to save it. I think there's going to be some serious backlash from just this debt that we've created over the last 15, 20 years in what's called QE, which saved the economy for that year, but it's just creating a big, I don't know, it's like stretching the rubber band. It's going to pop and it's going to hurt when it finally breaks.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And we're looking back at the most important events of 2025 that changed the financial lives of retirees, soon-to-be retirees, and investors. If you're unsure whether or not your portfolio is balanced for retirement, give us a call today here at Premier Retirement. Our phone number 520-780-9059 and request your no-cost Premier Retirement Roadmap. We'll show you how to protect your income and grow your wealth in today's market environment. Again, no cost, no obligation for this. It's the Premier Retirement Roadmap. It's just a casual conversation. 520-780-9059. You can also find out more about us online at premrent.com. Jeff, you talked about interest rates and retirement accounts a little bit. They were a hot topic in 2025. But 2025 also brought some tax changes for retirement accounts and income. What should our listeners know about what happened in 2025 there?
Well, of course, they always raise the contribution limits for 401ks and IRAs, and that adds a little bit of ability to save. But if inflation is keeping up faster than your paycheck is growing, you might find it's harder and harder to save that extra money. I think if your kids are gone and your mortgage is paid off, maybe you've got a better chance. You're at the end of your working life years, you probably have a chance to maximize and do some other savings. And that's typically when we like people to come in, when they do have that extra put away to give that final push and the home run. When you're rounding the third base and coming home, you want to do as best you can. You want to score. So people want to put away a little extra money, make sure they have that buffer in when they retire. But a lot of planning for retirement, some of the tax changes are not necessarily just because we can save more. The tax brackets rise a little bit. The good thing is Trump extended the tax cuts, which gives us at least another 4 years where we have tax brackets. And just to give you a perspective on that, before Trump tax cuts went into effect, about 8 to 9 years ago, the 25% tax bracket started at roughly $75,000 for a married couple, $75,000 as a couple you could have, and then your tax bracket on all your marginal income over $75,000 on your taxable income over $75,000 would be taxed at 25%. Well, due to the tax cuts, and I know they get a lot of flack for, oh, you're just helping millionaires and billionaires. That's not true. It's helping the middle class, because I think middle class are people making between $50,000 and a couple $100,000. The tax bracket is 12% up to over $100,000 right now, taxable for a married couple, or just right at 100. Then you've got the 22 bracket goes up to a little over $200,000, and you can have over $400,000 in taxable income and still only pay taxes at a 24% rate. Now, 24%, that still means you're going to pay about somewhere between $50,000 and $100,000 in taxes, even after all the write-offs you can find. The government then takes it and does whatever they want to, and it's like a black hole sometimes. But bottom line is, think about it, what a $300,000 or $400,000 income would have been taxed at just a few years ago. And those tax cuts might come back. So you've got 4 years of planning that you can do Roth conversions. You can do, let's pay off all our deferred taxable accounts, whether you've got annuities or IRAs, things like that, either convert them into Roth IRAs or convert them into LIRPs, life insurance type products that are stealth, that no longer generate 1099s, that you can keep money in, kind of like a tax-free bank, and never pay tax again. So this might be probably the biggest change that I saw was when I thought the plans were ending this year, as far as our aggressive tax planning, we got a 4-year extension. Some people are breathing a sigh of relief because they weren't able to get all their money out at a 24% or lower bracket. It was going to go back to a much higher bracket, and they were still biting the bullet on some of that, or planning to. But now they can breathe a sigh of relief and save tens of thousands of dollars in taxes over the next few years, maybe even hundreds of thousands of dollars in taxes over the next few years. If you look at the long term, even more, because the tax savings are greater now, those compounded tax savings will show up in your net worth down the road. So that's probably the biggest thing. Of course, there was a little tax break on Social Security. It doesn't affect most of my clients, but some of ones that live on less reportable income might get a nice little $6,000 credit on top of tax on Social Security. Your taxes on Social Security are limited based on your income. So people kind of in that touch and go area where you're just barely making ends meet and you're a little bit worried about those taxes on Social Security, you may not have to worry about that anymore. It might end up putting $5,000 or $10,000 if you look at the taxes you don't pay plus the extra credit against your taxes. Now, I'm not a CPA, so we've got tax preparers that know exactly how those rules work. But fact is, you are going to get some benefits. It's not totally free for everybody. Honestly, it's funny how the opposing party always points fingers at Trump, says he's only helping millionaires. You know what? That Social Security tax, that doesn't help millionaires at all. They're already in the tax bracket. They're already going to pay max tax on their Social Security. They're not getting any breaks. The people that are middle to lower middle class are going to be the ones that benefit most from that. So, those are pretty important tax breaks. The big, beautiful bill has a lot of things in it that I think can affect different people for different reasons. The main things are those that I just mentioned. If you're preparing for retirement, you can save a little bit more and get some tax deferral if you want the tax deferral. And the tax rates are extended, the brackets are extended for another 4 years so that you get a lot more time to do some tax planning if you want to undo those deferred taxes, pay taxes now on less money, then pay taxes at a higher rate on more money later.
Taxes can quietly erode your savings, so call 520-780-9059 and we'll map out Premier Retirement Roadmap showing you how to protect your wealth from those unnecessary taxes. Again, no cost and no obligation for our loyal listeners here. 520-780-9059. Jeff, let's wrap up this segment here about 2025 by talking about healthcare. Healthcare continues to be one of the biggest expenses in retirement. What were the highlights in 2025 as far as healthcare goes?
Well, I don't know. They're always trying to lower prescription drugs and put caps on those. I think the U.S. pays the brunt of the cost of pharmaceuticals, and I think they're still working on getting those down, yet they still continue to seem to rise to me. Medicare plans, supplement plans, the Advantage plan, which I don't like actually, and the supplemental plans have a few more options, but you got to make a good decision. Sometimes people don't like the deductibles and the fact that on Advantage, they love the fact they don't pay out, but if you can't choose your doctor or you have to wait and get approvals, that might not be advantageous to you. And the supplemental plans, they do cost extra, but you have a lot more flexibility. So there's a few more options there for those people that want supplement plans instead of the Advantage plans. There are some ways to cover those things that, the Advantage plans talk about with drug coverage and things like that. There's standalone plans that you can get to supplement as well if you want the extra coverage. Most of our clients like the extra coverage and can afford it, and they like the flexibility, being able to travel, not have to always stay within a network or have your doctor approve it and wait 3 or 4 months for medical decisions and treatments, but you can do what you want a little bit more actively. And I think the advances in the flexibility in the supplement plans have helped that. Long-term care is going through the roof. Medical inflation is going up 2 to 3 times as fast as regular inflation. That's even including the crazy years we had with Biden when inflation on everything was going up. But medical stuff is just through the roof. It's frustrating where that used to be the second biggest cost in retirement for most of our clients, taxes being number one. The second being long-term care or medical. I think that might end up eclipsing it and being number one. I mean, if it keeps going up the way it is. So how do you prepare for that? Honestly, I really don't like the pay-as-you-go plans. I like covering it with either, some people do it with just their mortgage or their paid-off house is their ace in the hole sometimes. They're going to be moving out of it anyway. Oh, well, use the equity to pay for it. Or what I like better is when you do LIRPs, life insurance retirement plans, that death benefit that you have to buy to do this tax-free banking thing, it's kind of like tax-free personal banking. It's like a Roth on steroids. But the cool thing is there's a death benefit involved in that. And if you get sick and need some sort of a long-term care plan or terminal illness, things like that, that might cost you extra out-of-pocket costs for medical bills, that death benefit is available to you in advance. You don't have to die to get it. That's why I truly call the LIRP, a life insurance retirement plan. It's a lifetime. It's during your life. It's not death insurance retirement plan where you just make somebody rich when you die. It's actually benefits you for those medical costs. But, if you do a good plan and you leave some buffer and plan for those things, you can see what you'd have available in 10 or 20 years on a very conservative basis if you look at the Premier Retirement Roadmap that we designed.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here. We're taking a look back at 2025, and we're going to preview 2026 in just a few moments. If healthcare costs have you worried, call us here at Premier Retirement for a no-cost Premier Retirement Roadmap. We'll make sure that your plan accounts for these costs without jeopardizing your lifestyle. You can get that going by calling 520-780-9059. It's 520-780-9059. Again, there's no cost and no obligation for this Premier Retirement Roadmap. Not only will we talk about healthcare, but we'll talk about preserving your wealth so that you can have a better retirement. We can also talk about creating income streams so you have an income stream that you can count on. Also, reducing taxes. The Premier Retirement Roadmap is complimentary, so request yours right now at 520-780-9059. Get 2026 off to a great start by doing that. Jeff, time for a break here on Premier Retirement. When we come back, we've got listener questions, and then we'll take a look at 2026 when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you joining us each and every week for Premier Retirement here on 790 KNST, Tucson's most stimulating talk. We're listening to Premier Retirement with Jeff Hogan. My name is Jeff Shade, and a reminder to get your flu and your RSV shots. Of course, I didn't do that, and you can tell by the sound of my voice. We're on the air for you 4 times this weekend, by the way, on KNST. We're on Saturdays at 7 a.m., also 9 a.m. and 1 p.m., and Sundays at 11 a.m., and as always, you can hear us on the podcast, wherever you get your podcasts. Search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement and growing your wealth. Okay, Jeff, time for listener questions. Patricia's listening to us in Tucson, and she asks, am I allowed to sell my house to my daughter way below market rate? It's paid off, and I would like to give her a head start in life. I would sell it to her for enough to allow me to pay cash for a much smaller condo. It might be good to just have her make the payments. The house has appreciated about $500,000 since I bought it, and my mortgage, which I could pay off, is 3.25%. I don't know if we'll see those rates again for a long time. What do you think of this strategy?
Well, I think that 3.25% is crazy good. There's some IRS rules, depending if you're trying to skip estate taxes and stuff and try to gift away assets. You kind of break the gift tax rules, but honestly, I don't know anybody that's going to audit you for selling a $500,000 house for $300,000 to your daughter. Now, somebody who works for the IRS might say, naughty Jeff, why would you ever recommend that? I don't recommend it. I just say that I don't think you're going to have any ramifications if you tried it, unless, of course, you're trying to get away with some sort of a tax code violation. The 3.25% mortgage is really good. If you were to just have her take over those payments or just rent it to her with her on as the beneficiary, it's the same as her owning the house, essentially, right? I guess, if something happened at the house, you'd still be liable. Make sure you have good insurance because your name would still be on it. If that was the case, she was just paying your mortgage. But she'd certainly have a smaller payment than if she bought the house and refinanced it at 7%. If she just took over the payments, where do you get the money to buy the new condo? maybe you work that out. I don't know all the information to give you the best scenario, but man, if I was to buy a house, I'd rather buy it at 500 full value and pay 3.25 mortgage. If it was somehow an assumable mortgage, or you could work it out that way, that would be awesome. If she paid you the mortgage payment, would it be enough for you to rent or to buy with a small down payment another house? But of course, you'd have a 7% mortgage, but maybe on a smaller amount. Again, you have to probably put the math side by side to see what makes sense, but you're thinking the right things, you're asking yourself the right questions, and that's really how we make the best answers, is ask the right questions. And we get the best answers, we ask the right questions and go through a few different scenarios and just see what makes sense. I don't know what the credit rating is and how easy it would be for your daughter to get a loan, how easy it would be you for get a loan. Sometimes when you're retired, you don't have enough income to make the mortgage company happy. They don't even like you borrowing money anymore. So there's a myriad of situations you could probably look at. You're looking at the right ones, I think, but those are options I can't really recommend without knowing more information of what I think would be the best. But that's my 2 cents anyway.
Patricia, thanks for listening to us in Tucson, and good luck with that. Again, if you'd like to talk to Jeff, 520-780-9059 is our telephone number. Okay, Jeff, next question. It's Carl in Rancho Vistoso. Carl says, a friend calls it the everything bubble. Why do so many economists fear a 1929 style market crash?
Well, there's a lot of signs that point the same direction. And the most dangerous words in the vocabulary of an investor are, it's different this time. It's never different. Well, I mean, the ending or the cycle never changes. It's always the same. We just don't know when. It might look a little different, become in a different color, a different variety of events that happen simultaneous to make this everything bubble pop. But there is a lot of bubbles. I mean, the economy's slowing down. Earnings are slowing down. We've got people paying way more for stocks than they ever have before. We've got credit at an all-time high. We've got defaults at an all-time high. We've got housing at a place where nobody can afford it. Eventually, people are going to want to sell their houses. They're going to be willing to take a lot less for them just to get out of them. And they might not have a choice. We've got interest rates still remaining high. We've got inflation going. There's just a lot of things that are culminating to end badly. And the main thing is it's driven by this crazy debt that the government has put us into. It's just the national debt. If we were rolling in a more robust way and Trump says he's going to fix it, maybe he will and get us out of it. I have high hopes. But the fact is these cycles have always repeated, and it doesn't seem to matter. Trump's just one guy. He can't executive order everything, and he can't executive order the economy to be good. He can change policy and see what a judge says and might shoot it down, or Congress won't vote certain things in. It's going to be hard to get everything fixed. That would make interest rates go down, get inflation under control, get the stock market at a better value. I don't see that happening without a crash and a recession and just kind of this reset period that we would have to go through to kind of start over, reevaluate the situation, make everything cost a reasonable amount. And we've already seen bear markets, like in crypto, for example. We've seen 28% of houses in Arizona have lowered their price in the last 30 days. I just read that last weekend. And Vegas market is right behind it. California is lowering prices, believe it or not. All kinds of states are backing off. So about close to a third of the houses that are listed are looking at price decreases within the first 30 days of listing. People are getting tired of waiting to sell. They're trying to maybe take profits. If that starts happening and it becomes kind of a snowball or exacerbates the sales process, that more people are going to have to try to be competitive, are going to have to lower their rates or their prices, then we might see a housing bubble pop. If the housing bubble pops, it'll probably filter into the stock market. If the stock market pops, it'll probably filter into the housing market. Those are the two biggest markets that have really cramped the lifestyles of Americans in the last few decades. But the fact is, Arizona just raised its minimum wage again, which means it's probably harder in a struggling economy for businesses that want to hire people if they have to pay more than they can afford for basic menial stuff like dishwashing and sweeping up and taking out the trash. I mean, there's certain jobs that really are easy for anybody to do, especially entry-level positions. And now it's 15, something just went up over $15. I think it's 15 and a half, whatever. But it's more than some companies can offer given the inflation that's eaten up the cost of goods, the producer price. Everybody wants more income to try to keep up with inflation, so they're paying their seasoned workers more. There's not a whole lot left. So I think there's a lot of economic indicators that show things are slowing down, not speeding up, but you won't hear it on the news. Who's talking about crypto anymore? Shoot, I used to trade a stock that was actually an ETF of Bitcoin. And, it's $25 up until just a few months ago. And now it's like 12 to 15. It's half. Who's talking about that? When all these people have been hyped into buying crypto, now that's going. People are losing money in that. There's a lot of companies even in the energy market that are down 40 or 50% from their highs this past summer. And that wasn't that long ago, but nobody's talking about that. So we're already seeing some pullbacks in stock pricing. We're just seeing a few big ones that are getting hyped that are still pulling the market ahead, making the indexes look okay. And, we'll see what happens. But the fact is there's all kinds of different things that are really at unprecedented levels at the same time. And that's why it's probably an everything bubble. It's not just the stock market's out of whack, but house prices are good and everybody can get jobs. Or, there's no tariffs anymore. So, we get prices real cheap. It's making things a little bit more equal. But we can't import stuff as cheaply as we could. It's going to take a while for manufacturing here in the U.S. to catch up to what was shipped overseas and has to be brought back. There's a lot of incentives to do that, but that might not happen before the bubble pops. So there's just a lot of things that I would be very worried about. And that's why we always preach, save what you have first and risk what you can afford to lose or, have pop in a bubble and wait for. It doesn't necessarily, when it pops in a bubble, it doesn't necessarily go away forever. It just goes, we have to gather up the pieces and kind of restart. And hopefully that doesn't affect the money that you're living on or the house that you're living in and the livelihood that you need to live your retirement on your terms. That's why I think accepting maybe a little lower guaranteed income, knowing you'll always pay your bills, is probably better than, if the market can just keep averaging 15 or 16 or even 22%, I think I'll do fine and I'll be able to spend as much money as I want. Well, that's great while it's happening, but it never happens forever. So be aware of the market correction that always rears its ugly head. It's going to happen eventually. It always does. I'm just a realist. I'm not a pessimist. I'm not the sky is falling guy. Shoot, we've got tons of money in the market. I just did some trades this morning for our client portfolios. We're restructuring and rebalancing, and we're going into those investments that look like they still have a upside. But I can't guarantee they're going upside. They could sell off and be down twice as much as what we thought they were going to make since we've owned them. You never know. So again, it's a market that is really, it's walking a thin line. There's things that happen, and I think people need to respect it and be aware of it and not get in that euphoric stage where we don't care about it anymore because it seems like no matter what, the government just fixes it or they throw more money at it or, the market always comes back. So far, it's been so good. Well, so far it has, but you haven't been retired for 3 decades yet. Wait till you have, and you probably see 2 or 3 major corrections during that time. If you just started in retirement and you can't remember the last one because it was while you were working and it didn't affect you, well, imagine yourself in those times. What would happen if the market went down 50%? Would you have to adjust your lifestyle? Could you wait 5 or 6 or 7 years for the market to come back to get back to even? Because that's what happens in real corrections when there's a recession attached, not a correction when they just throw $7 trillion at it and pump it into the market to fake us out and pretend there's earnings that there aren't or pretend that there's growth in companies that there really isn't. It's just money being printed and it's fake. And we've got to look around the fake and make sure that we're not getting too comfortable with fake and need to make investments that still have some sort of a fundamental basis. And fundamentals are pretty much non-existent right now. I got to say it. I've said that before, but I still like to bring them in when possible. And the fundamentals of the market it's way overbought, overpriced, and bad things happen.
Carl, we appreciate you listening to us in Rancho Vistosa. And of course, if you want to have a further conversation with Jeff, the number 520-780-9059. Thank you for listening to us. Okay, Jeff, next question is Ed, who's hearing us in Green Valley. Ed says, I'm widowed with 3 children, 2 sons and a daughter. Our daughter is the eldest. I have a very modest sum in my CD, checking, and savings accounts, approximately $150,000. I want to set up a payable on death, a POD designation on all of these accounts. Should I name my daughter as beneficiary in all my accounts or just add her name instead to the other 2? She's an intelligent and responsible individual.
Well, I don't know if you want to give all the stuff to your daughter. She has the legal right to keep all of it, and there's nothing to go to your other children. You can put POD and put all 3 of them as beneficiaries, and they can each take their distribution if, in fact, you want to give it to all 3 of them. I mean, you mentioned that, so I would imagine you want to share it around to the sons too, unless you would just want the daughter to have everything. You can do a power of attorney that would give your daughter the ability to pay your bills and take care of those accounts until you pass away. Then upon death, the bank would, at that point, distribute a third of those accounts to each of the kids when they come in and make their request. I mean, they might talk them into going over to the investment department, investing the money. They might talk them into buying another CD. One of your children might want to just take it out and move it to their bank in Michigan or wherever they live. So I think it's good to have all the names of all the kids on those assets if they are going to be a final recipient, because they can make their own decision on their third of the money. It doesn't saddle sister with having to get the money out, pay taxes, divvy it up, report to each brother. It's really more of a cumbersome situation. And unfortunately, that's what happens. Even though a lot of people like trusts, the simplicity of your estate would make it easier not to use a trust, but to use PODs, which essentially work like a trust. In fact, they avoid probate. They go directly to the succession of whoever you decide the successor is. And nobody really has to work the assets for the benefit of all the other siblings or all the other people, like in a trust you do. Now, to take it one step further, if you own a home, you can actually put a beneficiary deed on that home, file at the recorder's office, and you can name your children as the beneficiaries so that when you die, they can sell the house and divvy up. Escrow would see that on the deed and say, oh, well, each of the 3 children named get a third of the proceeds from this house after all the bills are paid or all the commissions are paid or whatever. One of the kids, if they want the house, could buy the other 2 out if they wanted to. But I think the beneficiary designation is certainly the cleanest and easiest way to distribute assets. The banks and even the local government now honors a beneficiary designation, keeping it out of probate, making it simple for your heirs. The contrast would be or the opposite of the beneficiaries, not necessarily the opposite, the same thing, but a different way to do it would be, like you said, put the name on your accounts. If you add your daughter's name to the accounts, any mess that she gets into could filter into you. If her name's on that account, it's essentially her money too. Just like a joint account would be with your spouse. If either of you get in trouble, you could lose your money. You could get sued out of it, or it could have a lien on it. I would not add her name on anything other than a power of attorney, so that if something happened to you and she had to pay the bills, write checks, or do things on your behalf, she could do that without getting her financial stuff messed up with yours. The other thing is she wouldn't want to put your name on her accounts either, because let's say you're driving someplace and you get in a wreck and somehow they decide it's your fault and they sue you for everything you have, and then they come in and go get your daughter's stuff too. So you have to be careful about adding names, because you're also adding increasing liability on those accounts as well when you do that. So I wouldn't do it with separate generations. Maybe with a spouse, no problem, because you're kind of in it all together. It's a community property state, so they kind of make the law work that way. But with kids, just use beneficiary designations and put it on everything you have, your IRAs, your bank accounts, your house, and just have maybe a small locator list of where everything is and who gets what, who gets the fishing equipment and who gets the jewelry and who gets, the lawn furniture, whatever. And you can designate that on just a little holographic will that you write out yourself. Nobody's going to make you put those personal belongings through probate. They can just come and do what we call pickup truck estate planning, where they come and get their share and drive off with it.
Ed, thanks for listening to us in Green Valley. Good question. And of course, if you want to have a further conversation with Jeff on this, remember he is an estate planning specialist. 520-780-9059 is the telephone number. Jeff would love to talk to you. Listening to Premier Retirement with Jeff Hogan here on 790 KNST. Happy New Year. We appreciate you joining us here for our first show of 2026. And again, if you'd like to talk with Jeff and get your Premier Retirement roadmap, no cost, no obligation. Again, that number to call, 520-780-9059, and you can make that call right now. Jeff, we talked about 2025 bit, so let's look forward to 2026. Of course, it'll be Donald Trump's second year in office as president. We're going to have a new Fed chair, too, sometime in the spring. What should people be looking to in 2026 that's maybe a little bit different than 2025, or do you think it's going to be more of really pretty much the same stuff?
Well, I don't know. I know that we're in an everything bubble, like we just said. A lot of things a little bit out of whack. Things that should have happened last year or year before might happen this year. Maybe they'll be kicked down the road again, and we'll be able to manage to weave our way through some volatility in the market and still end up ahead of the game next year. I've read most people want to claim a 5 to 10% increase in the S&P 500 or the indexes, which is kind of typical. I mean, over 100 years, they average about 10%, and they go up typically 7.5 times per 10 years. So you'd be silly to try to guess, because nobody knows when things are going to happen. You'd be probably silly to try to say, oh, we're going to definitely have a bear market next year. Everybody wants to say, hey, be careful. There might be. We're due for one. But you only got a 25% chance every given year that it's going to actually stay the same or go down. Even less percentage that it's going to go down more than 10 or 20%, which does happen every once in a while, but more like maybe once every 10 or 15 years, we have what's more than a 20% correction, a bear market, and typically a recession that lasts a little bit longer than 30 days, like the one in COVID when it went down 30+%, but they threw money at it so fast that it bounced. The market could stay down for a longer time next time. It may happen this year. It may start this year. I hope it doesn't. I mean, I don't ever want the market to crash. I think if it stayed a little bit stable, where it didn't go up as fast, and we could let earnings over the next few years catch up to where it is instead of going down and then waiting another 5 or 6 years, because people get rattled when the market goes down. When it gets so far down that they just can't stand anymore, then everybody capitulates and throws in the towel. And that's when the market makers swoop up and the market starts going up again. Then everybody's so scared because they lost money in the market. They're scared to get back in for another year or two and end up locking in losses. But that's because most people that do that have scared money in the market, meaning they have way more than they should. I mean, if you're going to write it down and write it back and not try to get scared out of it, don't put so much money in there that you say, uh-oh, if I lose any more, I can't make a living anymore. I can't live. I can't get by. I can't pay my bills. That's the danger zone that you just don't want to get into. You want to make sure that you have guaranteed income that pay all your bills, and then that discretionary expenses, whether you fly first class to Europe or whether you sit in the coaches, depending on how the market's doing, maybe the more discretionary type values. I use that kind of tongue in cheek. You know what I mean? The stuff that we don't really need, but would be nice to have, can come out of the money when the market's doing good and you can afford it. But if the market's down, you can't afford it. Then you get rid of those frivolous expenses or those what if expenses that you really don't need. But if you've got your income needs met and your principal protected on accounts and you're saving enough in taxes to spend the money instead of give it to the government to spend for you, you're better off if you have a plan where you keep more of your money and can make sure you get all the things you need to do done so you don't have to worry so much. So you're not the one that's capitulating and bailing out of the market if it goes down, if you do end up staying in it. Now, when we manage money, I mean, we see a downtrend and we run for shelter and we stay on the sidelines for a while till it goes back up. Yeah, sometimes we miss some of the upside, but we definitely aren't going to be in the market to ride it down 50%. I'm not going to be there, not with my money, nor should I if I'm managing money for clients. The market says, oh, just write it out, just leave it in there. Don't worry, you can't time the market. Well, you can't time the market, no, but you don't have to be in it when it's not comfortable or when it's going down. I mean, when the trend is definitely in place, you'll know it. It's going to be consistent. We saw it in 2008. There was no surprise after a few months. It was definitely heading that direction. And it did for a while, more than a year and a half. So you don't have to ride it around. But if you are just going to be a park it, hold, set it and forget it type investor, remember, set it and forget it with money that you don't need for your everyday bills. It's for your discretionary money or for your long-term money or for the money that you expect your kids to inherit from you 20 years from now.
Jeff, another thing we've talked about, Fed Chair Powell, of course, ends his term here in the spring of 2026. Do you think that that's going to signal more rate cuts because the new person is Trump's pick this time?
Didn't Trump pick Jerome Powell too?
Yeah, he did pick Trump. But the thing is that Jerome Powell many times butted heads with Donald Trump, and it seems that this new person is just like, hey, pick me, I'll do whatever you say.
Well, my point is we don't really know what they're going to do. I mean, they're supposed to be unbiased and not supposed to take their orders from the president. They're supposed to do they're actually supposed to do whatever the banks want. It's really to stabilize the banking system and the economy. It's not really to appease the president and make him look good, but they do occasionally, especially if they're politically aligned with them. And I assume that Trump will probably, now that he kind of knows who his friends are and who they're not, I'll bet he'll make a better pick than Jerome Powell and somebody that might listen and lean his way. I think it would be foolish for them to do massive rate cuts unless we start into a recession, which is really the only thing you can do to get out of them. But the thing is rate cuts generate inflation. They are very inflationary. And I don't think massive inflation is better than a recession. I think a recession where we reset and get inflation more in check it might be a hard pill to swallow, but it's like getting gut punched once so you don't have to get slapped upside the head every year for the rest of your life. Just take it, rip the Band-Aid off and be over with it. Otherwise, it's kind of a slow bleed and just a long, painful, grueling experience that nobody wants. So I'm not calling for a recession. I think we're due for one, and I don't know that it would be necessarily a bad thing. I don't know that the Fed chairman has not necessarily, I guess, in a way, they've kept us out of recessions by printing money, but we're at that point where we just can't do that anymore. Now, Trump might want to do it for 3 more years just till he gets out of office and let it fall on the next guy, but then they'll kick the can down the road too. I had a lady come in about 10 years ago. She says, oh, QE, that works, man. We're never going to get out of QE. It's just going to be QE to infinity. I'm just staying in the market the whole time. It'll never correct. I don't know. I'm starting to think now I thought she was Looney Tune. But now I'm thinking, well, you know what? Maybe that's what they do. Maybe they just keep printing money and don't care about what the ramifications are with inflation and how the middle class has to live. It's just about making sure that all the wealthy people that are donors that contribute to their campaigns and help them get in office and keep their power are taken care of. And maybe the market being strong is the way to do that. So if that's the case, then as middle class or trying to be middle class or upper class people who's trying to get by and manage to guard our wealth, make some smart decisions, save a little extra, make sure that you get on the ride, make sure that you get to take the ride as well, or get in assets that are principal protected, still go up when the market does and don't lose money if the market does end up correcting. So we think that diversification and balance is important, not just stocks and bonds, diversification and balance, but the type of money you have driving income, the type of money you have for principal protection, the type of money that you have for tax benefits, tax-free income, your housing, your long-term care plan, all those things, those 5 pillars of planning really mean you're diversified and you have all those areas covered, not just, gee, where's your stocks and bonds today and hope it lasts. I mean, Wall Street would love for you to think there's no more than stocks and bonds, but we know that there is more, and we know that those other tools will help you not just stay diversified, but help you get through the roller coaster ride that I'm sure that's ahead that we're going to see, and we have seen before. It's not anything new. I've been in this business long enough that this stuff happens. So let's just not act surprised when it does, or act surprised if somebody like me says, hey, be careful, be ready, because we're due for it, because we are. And you just need to make better decisions. Make sure you don't put yourself in a position where you have to go back to work when you're 70 or have to ask your kids for a loan or, heaven forbid, move back in with them.
Well, Jeff, after a whirlwind 2025, let's make 2026 the year that you take control. Call 520-780-9059 and request your Premier Retirement Roadmap. No cost, no obligation for that. Entirely complimentary. 520-780-9059. Get 2026 off to the right start by talking with Jeff Hogan. Well, Jeff, I'm going to take a break here and settle down with a little hot tea and honey. I want to wish you a happy birthday. Saturday is your birthday, my friend. What are you going to do to celebrate? Play some golf?
Well, just doing a radio show for one.
Beyond that, though. Yeah, this is a real celebration.
Kick back, go eat a steak. My daughter's birthday's on the 5th, so we're going to celebrate tonight. Hang out. Hopefully my throat will feel better. I'll be able to enjoy it.
Well, your New Year's babies, and, that's something special there, too. So anyway, Jeff, thanks for your time this week. I'm going to thank our listeners for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.